Cody Payne, welcome to the show.
Hey, appreciate it. Glad to be here.
Anytime I can talk with a fellow commercial real estate investor, somebody that's an expert and specializes in the industry and the space, I always get excited. We got a lot of people that love obviously real estate as a whole, as an asset class, but as you know, so many different asset classes within that general topic of real estate. What led you into real estate in the first place?
I was selling cars first, and always wanted a Cadillac. And I met a guy that said he thought he could help me get one, and so I went to work for him.
Nice. Okay, so you got a mentor that kind of pulled you into the space. And where specifically did you start? Did you begin on the single family side? Did you go straight into commercial or?
No, so I started in commercial, and I started on the small bay flex industrial leasing and sales side, and also working on a little bit of office as well. But yeah, no, I jumped right into the commercial side.
What do you say to the people that are waffling between single family and commercial? And I'll give you a little context to this because I wish I would have started in commercial right out of the gate when I began, real estate investing 14 years ago. But I thought, at the easy way, the safe way, the less complicated way would be to get into single family first. And that obviously was, not true. And I wish I would have, jumped right into commercial immediately. But what are your thoughts around the differences between commercial and single family and why you like commercial better?
I mean, I think there's definitely a lot more emotion involved in residential. I think everybody knows that. And so, each one takes, a different type of skill level. Anytime you're dealing with emotions, your sales skill level is a little bit different, right? You can't be too salesy. On the commercial real estate side, you've got so many avenues you can go, right? You got the leasing, the sale, and whatnot. On the investment sale, it's a little more analytical and understanding, rates of return, how to add value, where people can add value, what audience is looking at it. It's a pool that's constantly changing. Commercial side doesn't really have a true MLS. And especially if you're dealing in like multifamily storage, some of these asset classes, it's a very tight niche group that works in it. And so, residential is very co-broker friendly. And on the commercial side, what I didn't know when I got in, I didn't realize how unfriendly the commercial side was. I mean, we co-broker with people all the time, but I was surprised to meet a lot of people that were like, hey, this is a good building you have for sale. We got a guy that wants it. They're like, all right, well, just so you know, we don't pay any fees to outside brokers. And I was shocked to hear that. I didn't know that. And so, there's definitely differences to it. They have a lot of similarities, but I think one of the main things is probably going to be the emotion level, I would imagine, because on our side, tempers flare every now and then, which they do in anything. They'll flare, when you're in line at Walmart, but it's definitely a different aspect of it and a different kind of mindset, I believe.
Yeah, it's more the egos flaring up. Usually, right?
Which isn't any better.
At the end of the day, it's all data-driven decisions when you're talking about investing and, numbers that kind of tell the story on commercial. Whereas obviously, like you said, single family, there's a lot more emotional hooks in the transaction. What are some of the skills you would say for an investor and somebody to succeed in commercial real estate are amongst the ones of the best developers, the best investors, the most successful, most wealthy that you see? What are some of those skills and characteristics and qualities that make a great commercial real estate investor?
I think area knowledge, right? Because, anytime we're working on helping somebody build a, flex industrial park, or, if we're working on something, or even if it's just an investment sale, the area knowledge is very key because, you can have a city like Dallas that has so many different areas of it that, we see people make mistakes that will build in an area that they think is a good area, but it's actually not. Or, not understanding, how to, really how to add the true value to the product. The syndicators, sometimes we see them in some aspects overpromise and underdeliver, which that happens in any business as well. So, I mean, this isn't, I'm not breaking in any news here, but I think it's really kind of area and product knowledge based, because anytime we meet somebody that, does a lot in our asset class, I mean, they know what the build cost is. They know what adding the extra showroom glass costs. They know all these things. They know it all right here. And that's a very good trait to have, because that allows you to evaluate sites quickly and move on to the next.
Now, talk about small, bay industrial, flex industrial. Why did you decide to, make this your niche and just obsess over this asset class? What is it about it that pulled you into the space, and why you love it?
Well, it wasn't a choice. The guy that I was working for did big box industrial, like big box leasing.
Yep.
And I was real young at the time. I had a lot more hair, and I don't think he wanted me meddling with his stuff. So he said, "Go deal with the small bay stuff," which this is 2005. I give you, and nobody really. It was not a really good asset class. It was a lot of people called it like the dirty fingernail asset class. Like So I mean, it's evolved quite a bit. But I got in it. It's the reason I liked it initially, because I was actually leasing it. It was a high velocity leasing game. So, I mean, I was doing 60, 70, 80 leases a year on the lease side. Yeah. And so, if you get in the investment sales side and the market goes down, you're not selling as much. I mean, you feel that hit more than you would if you were doing that amount of leases, right? At that time, if I was doing, say, 70 leases a year and I missed out on 5 or 6, I mean, you really didn't notice it as much. And so I liked it because I liked the high octane, high energy, the move and go, not a lot of decision making involved in it. People would come look at the space, and sometimes they'd sign a lease right there. And, I could get paid, make that Cadillac payment like I always wanted, and move on down the road. And so I kind of fell into it that way, and then slowly evolved into the investment sales side and then development side, and built a really good team around me that's been with me for many, many years.
Beautiful. Now, talk about just the overall asset class and how it's evolved and what you see the opportunity with, flex and small bay industrial in today's landscape and maybe going forward.
Well, I think the best thing about it is I think it's one of the easier asset classes if you want to get involved in it and invest in it, or if you want to actually get in and develop it. I believe it's actually one of the easier asset classes for a new entrepreneur, new investor, new developer to learn. Its learning curve, I think, is much more friendlier, because the build side, I think that's what you're probably going to ask, because the build side is, in many cases, not as comprehensive, not as much moving parts in it. A lot of the spaces are standard size. You're not customizing a lot of things. And so developing the right model and, kind of finding a piece of land is, usually the best way to go, or finding a piece of land that tailors to that model. Obviously you got to do all your demographic searches, understand the area and things of that nature. But that's why so many people from like self-storage and other asset classes have been coming to it, because they do, they think it's got a much better learning curve, but it's also one of the more inflation friendly asset classes too, when it comes to re-tenanting. And so when you take all the asset classes out there, right, you got storage, you got multifamily, office, retail, hotels, you got all these, besides self-storage, when a tenant leaves and you re-tenant the space, small bay flex is right there next to it as far as cost to refinish out. Because as you know, like take the office, the office building class, for example, right, where TIs used to be 4 or 5 years ago, $15 a foot. Whenever a tenant left, now it's like $45, $50. And in a lot of the cases, those rents haven't gone up as much. And so when it comes to small bay flex, it's really basic units. A lot of times it's a garage, an office, and a restroom. And for the most part, that's it. And so when someone leaves, your refinish out cost is usually not as much. And also the tenant pool has really grown, especially since 2020. It's expanded rapidly. And so it's not uncommon, to see not just, light industrial subcontractors, landscapers, plumbers, this and that. I mean, these things now can have, showroom retail guys in there. It's not uncommon to have gyms, pizza joints. They've even got, certain retailers, as those guys, smaller retail guys aren't as reliant on traffic as much. We've even got buildings that have office space in them. And so they're really, back in the day, they just tailored to the smaller subcontractors. Right. But now today, these facilities can tailor to that entire pool, which is, I think, one of the largest tenant pools in commercial real estate.
100%. I mean, 1099 contractors, in general, independent contractors, entrepreneurs, that really has expanded in quite a big way. And then obviously, like you said, post 2020, we've got a lot of people that needed to get out of their house, needed to, keep running their business. You also saw just kind of somewhat of the utility of those spaces expand outside of that normal vein of, a service-based contractor to becoming, more office hybrid a little bit, right? You got, a lot of different uses for those spaces beyond just being, an industrial warehouse, right? That was kind of the common use of the space. So maybe we could walk some of our investors or aspiring investors through a process around how to kind of approach and look at this investment strategy from, I'm curious what you guys do in terms of how you identify key demographics, because I'm sure there are some markets, as we've seen, oversupplied with this type of product without necessarily the demand to keep up for it. We've seen some that just can't keep up with the demand, right? So from a demographic perspective on markets, on areas, things that you guys, do some due diligence on before you decide, hey, this is a great site to either develop, or hey, this is a great site to purchase. What are some of the things that you're looking at that other investors should be taking into account when determining whether or not this type of product fits into the marketplace?
So if you're like, okay, I want to build a small bay industrial park and I'm looking for a piece of land, what are some key factors that I need to look at, right? A few key ones that we look at is we really like the home ownership to be over 70%. Reason being, if you have too much renter and you're filling this up with subcontractors, there's sometimes not enough work for those guys if it's more of a renter market. And so you really want that home ownership to be on the higher side. If you are trying to do a showroom flex model, which is going to have a lot more glass on the front, to where not only you get subcontractors, but maybe you can get some tile guys, flooring guys, gyms, things of that nature. Some of the higher paying tenants. Then we start looking at spending per capita in the area and what that's being spent on. We also look at home growth. Obviously, if you're infill, you're not going to have as much home growth, which that's understood. You just then want to hone in on some of the other factors. We like home growth. One thing that we've really been looking at that I think a lot of people haven't been is, master plan communities have been really large here over the past few years, right?
Yep.
Back in the early 2000s, late 90s, you really didn't have those. And now you got these master plan communities that people are building, which are massive, that, have not just the, excessive amount of homes that they're bringing in, but also infrastructure, schools, retail, medical office, things of that nature. And so one thing that we've been eyeing is, hey, we want to find plots of land next to, a pretty good size master plan community as well. And so we've been eyeing that, but, traffic counts are big. We love frontage. It's not necessary, but you'll never say we don't want frontage on any deal.
Of course.
And so, those are the things that we look at is, the spending, the growth, the home ownership, the household value, household incomes, and all that stuff. And each one kind of tells a little bit of a different story. And then we'll also look at, okay, how many businesses are in the area today and how many were in there 3 years ago. And so we also look at the business growth as well, because, since COVID, the other thing that's helped out Small Bay Flex is, the expansion of e-commerce, and everybody, It seems like everybody's got a family member that's got a shipping business now. And, the commercial kitchens have also helped out these facilities quite a bit as well. And so there's a lot of different ways you can tailor it. And that's why you see these builds that people do that will really just be like all glass up front and garage doors on the backside. And you'll just have a versatile, unique mix of tenants throughout.
Which is pretty cool. It makes for a fun asset class for sure, even though the simplicity of it, right, in terms of how you manage and execute on, whether it's a development or a backfilling of the tenants in those spaces, it makes for a fun, diverse kind of ecosystem to play within.
I think it also, just by you saying that, I mean, what that also does is when you've got such a diverse tenant mix, that also helps you ride economic waves a little bit better too, because, as the office market or retail market or whatever market's kind of going up and down, you're not just tailoring to just this base. You've got multiple tenant bases that you can collect from. And so that's why I say that's probably the best thing about it is your tenant base is so much larger than what it used to be and a lot more diverse.
Yeah, yeah, absolutely. Which obviously talks about kind of at least one component of mitigating risk on this particular asset class. What are some of the other risks that you see, and or how are you guys, seeing investors mitigate risk in this asset class when it comes to small bay and flex industrial?
So one thing that is, it happens with any asset class that's hot is, making sure you're not getting into an area that's overbuilt or will be overbuilt, right? I think storage is like the king of that. We've got storage guys at the office and they always joke about it. They say, hey, if you want to build a storage facility, storage guys say, find a storage facility and build right next to it. And I mean, it's not uncommon even with the small bay flex. And so you want to make sure you're not getting into an area that can get overbuilt. You want to make sure that, if you're going to get in an area that already has small bay in it, you want to amenitize the asset class. And that's one thing that a lot of people don't do.
Talk about that a little bit more.
Well, yeah, and we talk about that all the time because amenitizing is what has really been going on across commercial real estate, right?
Right.
And people call it the flight to quality and other stuff. That's why you got office buildings and hotels, multifamily. I mean, they're always trying to out amenitize each other, and it's really no different in this because if you're going to go into an area where there could be competition or is competition, you want to look at, all right, what amenities can I offer that nobody else does, right? Those can be storage side yards, right? A lot of people don't do those. Those are like gold right now. Mezzanine space, like you and I were talking before we were online. You'd be surprised how many spaces out here are not air conditioned. And people will pay up for that in many cases. And, parking, storage, covered parking, higher ceiling height, signage. I mean, there's a lot of things that, people can do to these to not just help add value, but also help with tenant retention.
Yeah. Yeah. Obviously looking at your competitors in the market is key to see how you can be an outlier in a good way by offering some of those things or baking some of those things into either your development or your CapEx. Talk about how you guys analyze these deals and maybe what some of the rules of thumb in terms of metrics and KPIs you guys are seeing your investors look for or investors are getting that you think makes for a good deal, and maybe what others can use as somewhat of a criteria for how they look at these investment opportunities.
Gotcha. So to start on the development side, we need our coverage in many cases to be at least 30%, right? And a lot of times if, we're buying the land anywhere from, $3, $4, $5 a foot and you got that coverage, you need to be at least $12, $12.5, $13 plus triple net on the rate for it to make sense. If you're going in and you're buying existing, it's not uncommon for these I mean, the cap rates are really all over the place because the best part about this asset class is unlike multifamily and others, that the value add stuff has already been picked over. There's still quite a bit of that. We just closed 2 parks that were both their rent. It was an older ownership that had it, and their rents were near half of the market. And so that's not uncommon to find. It's getting less and less common, obviously.
Sure.
But there still is good value add parks that are existing that people can buy, add the value to, keep, flip, whatever they want to do. But when it comes to cap rates for stabilized, depending on the area, if you're in a Texas market, Georgia, something like that, you're probably going to see high 6, low 7s going in. Good news is rental rate growth has been pretty good. Obviously some markets don't have it as much. We've seen 5% in many markets, which is pretty good, especially if you're on triple net leases and you've got your expenses covered. Occupancy rates have been very good across the U.S. But there still is a lot of build going on. Like take Texas, for example. I think there's, nearly 10 million square feet that's proposed or under construction. And that's a lot. But as we know, not all proposed does get built. And so, it really depends on how you're going into it. If you're going to build, then, you've got figure out obviously your cost, your debt cost, if you're syndicating your payback cost, because you're going to have about 18 months before you start making a single dollar out of the deal. But on the existing side, like I said, there's plenty of opportunity on that front.
Yeah. And what kind of, return thresholds are your investors aiming to get on these types of deals so people can understand what they're competing against when it comes to, engineering the financial models and where they're going in at and what they're trying to get on the back end?
I know there's several funds that we work with that we sell to and help build, and they offer anywhere from 8 to 12 for the most part. And that's on new build, new construction. And then as far as existing goes, we see a lot of those guys running 7, 8, 9, 10.
Okay, makes sense. Now, how are you guys finding these opportunities? Where are these deals? If somebody were to go, man, this sounds interesting. I wanna start looking at some more of these opportunities. Where are you guys finding them? Where are your investors finding them? What are some of the common run of the mill strategies, and maybe what are some of the more advanced strategies you're seeing investors do?
Well, if you want to find and you want to if you want to do new development, then you really need to seek somebody out in that specific area, right?
Yeah, you got to be somewhat more of an advanced.
You want to be, yeah. You want to be, you want to
investor.
get in. You want to, yeah. You want to get in with the right folks in the right area, and not rely on somebody that is not as familiar with the area, because land can be pocket deals as well. When it comes to getting existing products, that's pretty easy. I mean, that's what me and my guys do for a living. That we sell the parks, and so anybody can always reach out to us or somebody else that specializes in small bay flex across the U.S. And we can help people understand, hey, these areas produce these returns. These kind of buildings, these kind of rental growth. These areas maybe have a little bit more value add component to it. You can still find these older mom and pops. Do you want to get into a metal construction? Do you want infill? Do you want to fight with the institutions? What do you want to do? And so, we help people all the time that want to get into it. And like I said, that's actually been the funnest thing over the past couple of years, is the amount of cross asset investors that have been coming to it. We just sold a really large park actually in North Fort Worth to a group that was mostly office investors over the years. And, they wanted to look into diversifying. And so, reached out to us. We sold them a beautiful park out there. And we've done that for a lot of guys. We've done several with multifamily guys also. They love the management side of it, because they go, we don't see a phone call after 5 o'clock, and the tenants mostly take care of the spaces themselves. And so, it's also a very management friendly asset class as well.
Yeah, I was gonna just ask about that. For those that are going, man, I don't know if I want to be managing real estate, and I'm looking for passive stuff. Talk about the different ways that you can make this asset class passive, and just talk about maybe the different ways that you can manage it, pros and cons.
Yeah. So look, if you're looking for passive income, obviously an LP is always going to be your best way to go. But if you want to own something that's a little easy, on the easier side, management companies love these asset classes because they're low management tenants. And a lot of times, if you've got the triple net leases in place, the tenants take care of the places themselves. So, the management side of it's generally very friendly. Unlike, self-storage, where, those units are turning over consistently. Multifamily, they see, good turnover. Small bay flex, you can always hire a management company and a leasing guy. They'll get, a lot of times they'll get you taken care of. I'm sorry, what was your other question?
Yeah, just around kind of the pros and cons of, managing this asset class, and how you can make it as, management non-intensive as possible. You alluded to, obviously the certain types of lease structures. Those are some of the things that, I think investors should be thinking about as they're engaging in an asset class like this.
Yeah, and so if you're looking for a more friendly lease structure, obviously triple net's the best way to go. We do see a lot of industrial growth, which means the landlord's taking on a little bit more responsibility, not getting reimbursed for taxes, insurance, and common area maintenance. And so, outlining those, is going to be, I think, key. I mean, as far as the cons go on the management side, I mean, you do typically need somebody to management, so that's really the only con. Management fees we typically see run around 3 to 4% of the gross income. But like I said, the good news is it's not hard to find a property manager for this type of stuff.
What's the likeliness of, someone going into this and actually getting triple net leases for this asset class with, it obviously would probably depend on what other similar product in the market is offering, and, how you match up to that. Probably the type.
It's not hard at all. When I first started, they were mostly gross leases. That's not the same situation as today. We're bringing out 3 projects right now. They're all triple net leased.
There you go.
So it's becoming a lot more common.
And for those that don't understand what a triple net lease structure is versus maybe a gross lease, can you explain that a little bit?
I have no idea what it is, actually. No, I'm just kidding.
I was like, damn, man, I got the wrong interview.
I was hoping you would not ask that. No. So a gross lease basically means the tenant just pays their rent and that's it. They have no other charges on it. You as the landlord, you're going to take on the repairs, maintenance, taxes, insurance, everything. When you have a triple net lease, the tenant's going to reimburse you for those items. And a lot of times in those leases, obviously it depends on how you structure it, but a lot of times those leases, those tenants take care of everything in their own space, right? And so how we like to structure them is, they take care of their AC, they take care of everything. So if there's a problem they have, they call and get it fixed. They don't call us. And so you've got that. And then obviously you got absolute net, which you don't see as much on the small bay unless it's, just a few tenants. We have seen it. And that's where you can actually bill back for roof and structure. But it's going to be very rare. Most of them are going to be on triple net leases or industrial gross.
Yeah, but it's as you mentioned, right, a great way to pass back those operating expenses back onto the tenants for their pro rata share of whatever they're taking up in the building, and it ultimately just inflates your value, right? Because you're dropping more and more to the bottom line or your NOI, which is obviously how commercial real estate is done. So, that's a good investment / value add strategy for those that might be looking at this in terms of buying a building that might be on all, full service gross leases. And just by transitioning over, your tenants to that triple net type of lease structure can make a significant difference in your value and the returns you get on that investment.
Oh yeah, no, I agree. Cause when you're on a triple net lease, just take, for example, say your rate's $12 a foot, that's your base rate. And then you got your nets on top of it. A lot of landlords, or a lot of investors will buy projects that they think they can bring the expenses down and increase their base rent.
Yep.
And so, cause your base rent's your profit. Your triple nets are just your expense reimbursements. And so, that's something that we see quite often is people coming in and going, hey, this guy's running at $4 a foot. We can get it down to 2.5. And now what they then do is then bump the rate up for the tenant on the base rent side. Now you're collecting an extra $1.50 a foot just in base rent. And so it's not uncommon to see that, office space and retail, a lot of those guys are big on that.
Yep.
And so it's the same in the small bay side.
Yep. It's just understanding how to play the game and, strategizing and seeing where that arbitrage is. That's the beauty of commercial real estate, man. And which I love so much is, you don't necessarily have to get out there and swing a hammer and do all this heavy lifting to get, forced value into your asset or to, juice some of your yield. You can go and do it on a piece of paper and just get strategic with how you're structuring your leases with your tenants.
Oh yeah, you can get creative. I mean, you can get creative with expenses, expense reduction, on the build side. I mean, there's so much you can do to it as well. Like I said, this asset class has evolved exponentially over the years, and I see it continue to do so. And I think it will be a heavy institutionalized owned asset class in the future. I think it's on a similar trajectory as self-storage, which is, anytime institutions own a heavier part of the asset class, that all that does is compress cap rates, which brings pricing up.
Yeah. Yeah. So talk a little bit more about that in terms of, I was going to ask your future outlook on the asset class and maybe the industry and the market as a whole. You seem to be very bullish on this. Some people, might say, is it overdeveloped? Too many people already in that asset class or space? Sounds like you feel the opposite. What are your thoughts on that?
Man, there's plenty of room to grow. And it's because of how diverse it is. I'll tell you, I mean, it's mostly privately held real estate as it sits right now, which, I mean, as you know, self-storage was the same way in the late 90s, early 2000s.
Yeah.
And that was mostly what, people call mom and pops or private ownerships. And, today it's one of the heavier institutionalized asset classes. Multifamily is, heavy institutionalized. So is office, so is retail. This is not, but it has started to gain more and more percentage on the institutional ownership over the past 5 years. And it's because they see it as a good inflation fighter asset class. They see it as a good cash flowing asset class and, a really large tenant pool. And that's why they like it. And so groups that we approached 5 years ago, 10 years ago that said absolutely not, a lot of those guys are looking at it and actually buying it now. And so you've got a huge, and, Blackstone, one of the largest institutions in the world, just a couple of years ago, I mean, they made a huge splash buying billions of dollars worth of flex all across the U.S. And so that just tells you how much that they believe in it as well.
Yeah. Now, for those that are trying to wrap their head around, the financing and the debt and equity structures, what are you seeing right now, and what should people be thinking about in terms of how to, financially take some of these assets down?
Well, obviously, if you're going to do a new construction, you're going to get a construction loan, which are, just to be honest, man, they're not the friendliest right now.
It's tough,
And
tough making those numbers pencil.
Oh, I know, but we still are. We got guys financing anywhere from 8.5 to 10% on projects, still penciling. A couple of recent deals that we did as far as existing investment, we've seen 6.75, 7.25, 7.5, and 8% done on those.
Okay. And in terms of kind of loan to value on those, what are you seeing on that side?
So the two that I was telling you about that were severely under market, they had to come up with 50% down just because their rents were so under market.
Okay.
But their game plan is to quickly convert them because they were short-term leases. So, they've got a 1-year strategy to convert a lot of those guys and refinance and get some of that money back out. Traditional, when it's stabilized, we see people getting away with 30% down right now.
Okay. There you go.
It's not bad.
Not bad at all. Now, if individuals are looking to learn more, to get in the space, they want to connect with you, what's the best place for them to connect with you guys?
Easy. flexbusinessparks.com. You can find me and the team there. We've got everything you need to know, different models. We actually have financial models that people can download and use. We've got a great book that people can access. We've made it very friendly for a lot of people across the U.S. that are looking to get into it. And obviously, me and the guys, we're super easy to get a hold of. We're always on LinkedIn and having a good time.
Cody Payne, thanks for coming on the show, man. Appreciate it.
And I appreciate it.